A is number 21. Consolidated financial statement. Accounting standard for consolidated financial statement. You have to understand the concept of group of companies where company H has shares in S which is more than 50%. Then this company is called holding company. This company is called subsidiary company. Holding company will prepare their own balance sheet and subsidiary company will also prepare their own balance sheet. Apart from that, holding company should prepare consolidated financial statement combining the balance sheet of holding company as well as subsidiary company both. Okay, holding company and subsidiary company is both. It may be not only balance sheet, it may be for P&L account as well as cash flow statement also. At inter level, you have to concentrate only on the balance sheet. Okay, consolidation of profit and loss account as well as consolidation of cash flow statement is only for understanding purpose. One illustration is given in your CA instrument material as well as in Singar Academy's book. So you have to be master in consolidating the balance sheet here. Right. These two companies put together will be called as group of companies. H and S will be considered as group of companies or companies comprises holding company and subsidiary companies. The accounting standard number is very fantastic one here, 21. Two companies balance sheet are merged into one company's balance sheet like. So H company prepares their own balance sheet independently. S also prepares their own balance sheet independently. Apart from that, in the books of H company, only in the books of H company, they have to merge the balance sheet of H as well as S collectively, right? That consolidation will be done here. Yeah, of course, some theory portion also be there, but for the calculation part, this particular page is very, very important. So for solving the illustrations for the consolidation purpose, you have to follow these 6 steps. And of course, while following these 6 steps to consolidate, sometimes we may have some adjustments. So you have to understand incorporation of these adjustments while preparing the CFS. So H company holds share in S company. Step number 1, calculate the percentage of holding percentage. Minimum 50% share should be held by H company in S company equity shares. Only then H company can control S company. Then what could be the real percentage? It may be 65 or 70%. That you have to calculate. Number of shares held by H, number of shares available in S. Okay, based on that you can calculate the percentage of holding to decide whether controlling interest is there or not. Second step, in S company they have the profits and losses, right? The profits and losses are going to be segregated into capital profit as well as revenue profit. Is that okay? Capital profit and revenue profit. Capital profit, when you are making any payment, right, for purchasing the share, you will make the payment for the share price, not only for the share price. Any profit accumulated is supposed to be distributed. For that also you will make a payment. Buyer and seller, company XYZ, their share price being 10 rupees. Profit already earned, supposed to be distributed 4 rupees. Okay, not at all distributed. If you are going to keep it for a matter of 1 week, you will get the 4 rupees distributed by way of dividend. So the price is 10, the company announced 4 rupees is going to be declared. You have to wait for 1 week. Now come on, tell me, what price yes may demand for selling the share of XYZ Limited? Okay, what price? Is it 10 or 14? Definitely it will be 14 rupees. Yes, is also pretty sure that the share price is not 10, sir. A matter of weeks of holding, weeks of period holding, I may get around another 4 rupees, or I don't want to sell it for 10. Give me 14. B purchased it for 14. What is journal entry for that? What is journal entry for this? It's only investment, right? So investment account debit to bank. What is the value he paid? 14 rupees. 14 rupees. But after 6 months, this XYZ company made another 2 rupees. This 4 rupees not distributed. After 6 months, this 4 rupees already available, 4 rupees being the profit, another 2 rupees also earned, together with 6 rupees is declared as dividend. Declared as dividend. So B purchases from S paying 14 rupees, counting the accumulated profit as on the date for the purchase price. So he paid 14 rupees for the share as well as another 4 rupees for the accumulated profit as on the date. But of course, he is not receiving that in a matter of a week's period. It takes time. Sometimes it takes 1 year also. Dividend may be payable only once in a year. So he waits. But at the time of real declaration of the dividend, the company made another 2 rupees profit. So existing 4 and 2 put together 6 rupees dividend is received. Now what is the journal entry for the receipt of dividend? 6 rupees is received. What is the journal entry? Come on, tell me. Bank account debit. How much it gets? 6 rupees. 6 rupees it gets. Am I right? Come on, tell me. What is his gain? What is his gain? If he gets 6 rupees as a dividend, what is his gain? 2 rupees is gain. That 4 rupees already he paid. He paid and he is getting it back. At the time of purchasing the share itself, the accumulated profit on the share is 4 rupees. He paid for that. On recovery, it's going to be net of that. It's nothing but returning off his own investment. So, bank account debit to investment. How much is that? 4 rupees. After folding, the company earns and gives another 2 rupees. No, that only will be considered as his income called dividend transferable to his own account or paid. This will be called capital receipts. This will be called revenue receipt. Revenue receipt will be transferred to the P&L account. Capital receipts will be adjusted only in the concerned assets and liabilities account. So in the assets, in your balance sheet, you show the assets investment value being 14. On recovery of the 6 rupees, you subtract 4. Hereafter, the investment value is only 10. Right. This XYZ company will have balance sheet and showing the value of equity share capital being 10 and accumulated resource and surplus being another 4. That's how it is shown at the time of purchasing. After purchase, this 4 rupees is now distributed. Hereafter, the equity share capital is only 10. For me, I paid 14 rupees. For the 4 rupees also I paid. On recovery of that 4 rupees, it's nothing but what I invested, I am getting it back. It's not returning of return on any investment earned. It's only returning of investment. What I invested, I am getting it back. So it's called a return of investment. This is called return of investment. Okay, return of investment is nothing but returning of investment. And this one is called return on investment. What does this mean? What does it mean? I invested, that investment worked for 1 year and fetched me 2 rupees gain. I worked and earned, then it's my revenue receipts will go to the P&L accounts credit side. Clear? So it's mandatory requirement to find out what could be the total profit in the subsidiary company, and that profit is segregated. How much profit we have at the time of real acquisition. Okay, that is called capital profit, because the amount what I am paying is for this one also. Not only for face value, any profit accumulated as in the date. Thereafter, any earnings is there, no, that is called revenue profit, will be transferred to the P&L account. So, second step is segregation of the resource and surplus into capital as well as revenue. So, step number 1, you have to find out the holding percentage. Okay, holding percentage, if the company holds 60%, balance 40% held by outsider. The outsider's holding will be usually named as minority interest. Second step, reserves and surplus will be segregated into capital profit and revenue profit. Okay, so capital profit and revenue profit, or capital receipts and revenue receipts. Capital receipt and revenue receipt. Revenue receipt will go to the P&L account, and capital receipt, will be part of returning of your investment, will be subtracted from the investment. While investing, you may pay money, no? By the time of receiving that, this amount is subtracted from your investment. It's a part of your investment. Okay. This is not part of your investment. It's nothing but return you earn because of that investment. It's your gain. Third step, you have to find out the cost of control, as well as fourth step, you have to calculate the minority interest. Cost of control is nothing but how much you pay for acquiring the shares in the subsidiary company to take the control of that company, and what's the net worth of that one. So I paid cost of acquisition of the shares I purchased from the subsidiary company maybe 1,000. What is the net worth? The net worth of the shares in that company may be 1,000 or 800 rupees, or maybe 600, 1,200 rupees. If the net worth is less than what I pay, I am paying excess. If I pay excess, what does it mean? It's called goodwill. If I pay less than its worth, I gain 200 rupees, then it is called capital reserve. The same, what we have already learned in amalgamation will be applicable here also. The same term. 60 or 70% I am purchasing that by paying some 1,000 rupees. And what's the net worth of those shares by the time? Right. If the net worth is more than my acquisition cost, then I'm pretty happy. If the net worth is lesser, but I'm paying more, that's lost, named as goodwill. To the extent of shares held by the outsider will also be calculated, which is called minority interest. Shares held by outsider. Step number 4. Step number 5, then you can prepare consolidated financial statement. Consolidated financial statement. These are the 5 predominant steps you have to understand. And of course, 6th one being, this may be a subsidiary company. By holding more than 50%, the other company will be considered a subsidiary company for this company. But later I disposed around 40 or 50% shares. Thereafter, I don't have the controlling rights. So the subsidiary status is now lost. How can we treat? That will be called disposal of subsidiary, usually applicable at final level. You don't need to worry about it. So you have to follow these 5 steps. That's more than enough. So by keeping these 5 steps, you can solve all the basic illustration. To make the illustration complicated, we need to include some adjustments, like we learned in amalgamation also, intercompany owings and unrealized profit and unsold stock. The same will come here also. Right? What are the things we learned there? Mutual owings, debtors, creditors, BR, BP, debenture and investments. The same will come here. Unrealized profit and unsold stock will also come. Apart from that, the unique adjustments with respect to the CFS being dividend treatment, bonus share treatment, revaluation of assets and liabilities treatment. These 2 are similar to the way how you learned in amalgamation is applied here. So additionally, you are going to learn only 3 more adjustments here exclusive for the CFS purpose. One is dividend purpose. Another one is bonus. Another one is the assets and liabilities of the subsidiary company may appear at its own book. At the time of valuation, the value is totally different. So now you have to make the adjustments for the today's worth. That will be called revaluation of assets and liabilities. So these are the 3 steps here. 3 adjustments predominantly you have to learn here. Clear? Now, so how can you calculate the holding percentage? Very simple. A company holds shares in B company. Around 600 shares held. B company has 1,000 shares. So what does it mean? Out of 1,000, A holds 600 shares, isn't it? Then it is 60%. Balance being 400 held by outsider, that will be called minority interest. So holding companies, shareholders, shares held by holding company divided by total shares in subsidiary company, and shares held by outsiders divided by total shares of the subsidiary company. It's very simple. Step number 1 is very simple. Clear? Step number 2, any resources surplus, capital reserves, profit and loss, or whatever it may be. See the resources and surplus of the subsidiary companies. Find out the resources and surplus exist as on the date of acquisition. Okay. For example, H company, S company. H company's balance sheet under reserves and surplus, profit and loss, and general reserve. Profit and loss being 1,000, general reserve being 500. Is that okay? Is that okay? Now, note, H Limited acquired shares in S Limited on 1st July 2024. On the date, S Limited had P&L account being 800, GR being 450. Now what happens here? So the resource and surplus general reserve being 1,000 in total, profit loss general reserve being 500 in total, profit or loss being 1000, isn't it? Out of that, capital profit is nothing but the profit accumulated already as on the date of purchase. As on the date of shares purchased by the H company and S company being 800, thereafter 200. Similarly, GR as on the date of acquisition 450, balance being 50. This will be capital profit, this will be revenue profit. This will be otherwise named as pre-acquisition profit, this will be named as post-acquisition profit. Pre-acquisition profit and post-acquisition profit. This pre-acquisition profit will be part of the purchase price. I am paying the money not only for the shares face value, I am paying for the capital profit also. Clear? So step number 2. Step number 3 is to calculate the cost of capital as well as minority interest both parallelly. So cost of capital as well as cost of control. Cost of control. Then here minority interest. In case of cost of control, you have to find out the net worth of the company's shares you purchased. Okay, you paid say so much money, book value of the share, and all the capital profit will be taken. All the capital profit, because you are paying not only for the face value, any profit accumulated as on the date of acquisition. No, that will also be forming part of your purchase price. You decide the purchase price or sale consideration based on the accumulated profits as on the date. So you just verify what is the total balance they have as on the date. See here in this illustration, this value will be taken to the extent of holding company's share added with the face value. So face value and capital profit. So if this value being 1000, these two value being 800 rupees, you pay more. So that 200 rupees is called goodwill. Otherwise, it may be capital reserve. So leaving that, rest of the capital portion held by outsider, you can calculate, that is called minority interest. Minority interest. See the net worth. This net worth can be calculated based on asset side approach as well as liability side approach. In case of liability side approach, share and capital profit will be added. Shares and share capital and capital profit. In case of liability side approach, assets minus liabilities is the format to get this net worth. Right. Then you can go for the preparation of this one. Preparation of final accounts means consolidated financial statement. Okay, so calculate the percentage of holding, segregate profit and losses into capital profit and revenue profit, and calculate cost of control and calculate minority interest. These are the 4 predominant. Finally, you can prepare the consolidated balance sheet. If you don't have any adjustment, how the illustration will be? We will start with that. Illustration seems to be very easy now. Let's start with basic illustration. Practical question. Wholly owned subsidiary company. Wholly owned subsidiary company means H company holds 100% shares in subsidiary company. No minority interest exists. 100% holding or 100% voting rights when we have minority interest nil. Okay. Now let's come on. Try to solve this illustration. See, the illustration is very simple. Whether you follow the format or not, the sum is very simple. What is the net worth of S Limited? S Limited, equity and resource and surplus. We assume the resource and surplus also exists as on the date of acquisition itself. So 600 rupees. What is the amount paid by H Limited for acquiring this company's shares? How many shares are there? 10 rupees each. 400 means 40 shares. Entire 40 shares purchased by H Limited and S Limited by paying how much? 600 rupees. Net worth is 600. Payment made is 600. Cancel that. Rest you can add up that directly. 1000, 600, 400, 700, 2000 and 700. This is what about the consolidated balance sheet. So simple. So simple. Is that clear? Anyhow, we just follow the formats here. Clear? So simply knocking off the parallel values. In the next case, wholly owned subsidiary company. Again, here also 40 shares. Now, what about the net worth of S Limited? 600. How much is the payment cost of acquisition? 700 rupees. What does it mean? You are paying more. If you are paying more, then that excess payment will be called as goodwill. So, the 100 rupees will be non-current assets, intangible assets, goodwill. Intangible assets, goodwill. Okay. So, now knock off the rest and do the line by line addition. So, 1000, 600, 400, 700, 1900 dash 700. Hope now you'll be able to understand this one. The sum is very simple. So in this case, only 60% is held. Only 60% is held. So what is the net worth? 600. How much held by H? How much held by outsider? 60% held by holding, 40% held by minority interest. 60% is being 360 and 40% is being 240. Now, the net worth of the shares held by holding company being 360, how much the payment is made? 300. For the 360, you are paying only 300. So, you are paying lesser, knock it off. So, you will get capital reserve 60. And now you can do the line by line addition. This 240 remains uncancelled, will be shown here above the non-current liabilities, below the shareholders' funds, minority interest. Minority interest. Rest of the things are same. Rest of the things are same. Is that okay? Equity share capital being 1000, reserves and surplus being 600, capital reserve 60, the shares held by outsiders, their net worth is 240, current liabilities being 700, and tangible assets 2300, and this may be 700. Hope now will be tallying this 3000. Is it tallying or not? So simple. So simple. Okay. Especially CFS, if you are very strong, that too along with those 5 adjustments, you can finish up just like that. In a matter of 10 minutes, you can finish up one illustration. A comprehensive illustration can be completed in a matter of 10 minutes. Right. Telling or not? This 400 non-current liabilities. Okay. Yeah. Now tallying, right? Anyhow, listen. I am going to follow the steps here. Step number 1. Step number 1. Holding percentage. Okay. H company holds how much? 100%. What about the holding of minority interest? Step number 2. Segregation of profit and losses into, okay, reserves and surplus into total and capital profit, revenue profit. The profit already available as in the rate of purchase will be called as capital profit. The other way, it may be stated as pre-acquisition profit, and revenue profit could be named as post-acquisition profit. So here I am going to take the 200 rupees. If any value is taken from the balance sheet, thereafter you should not worry about that. I posted here, this will be ultimately posted somewhere. You have to cross verify. Taking a number from the balance sheet to the working note, ultimately the balance you get in the working note should also be incorporated somewhere. If you do so, then definitely it will get agreed. So this 200 rupees, entire 200 rupees exists at the time of purchase itself. So there is no any profit earned after this. So this will be capital profit. So the overall total 200 is segregated into capital profit as well as revenue profit. Revenue profit is 0. Now the question is, out of this, how much is for the holding company? How much is for the outsider? Okay. Of course, outsider being 0 here, everything will be for the holding company only. Step number 2. Step number 2. Step number 3 and 4 can be opened parallelly. One is all about cost of control, fourth being minority interest. What is the amount you are paying? Cost of acquisition. The cost of acquisition for these 40 share being 600. I am taking this out. Here 600 rupees. Minus net worth. Net worth, the face value of the share. How much is that? 400 rupees. Now, what about the holding company's worth here? 400 into 100%, entire 400 is for the holding company share only. What about the equity share capital for the minority interest? Their share is 0. Apart from that, any capital profit you have no that will be also part of this one, because you are paying the money not only for the shares face value, any accumulated profit, and that will also be cost considered as your cost of acquisition. So here capital profit is going to be addable, and then this entire profit will be addable here. Capital profit or revenue profit, whatever it may be, will be addable here. Nothing is there, and this one will be transferable directly to the P&L account. Okay, in the holding company's P&L account. The profit I earned after the acquisition will be my profit only, will be included in the profit itself. Profit already available at the time of acquisition is the part of the consideration. So I take this one here. So I paid 600 rupees. The net worth at the time of purchase being also 600 rupees. So I don't have any profit and loss here. This is called no goodwill, no capital reserve. So minority interest also 0. So from here I take this value here. The ultimate value 200 also taken here. The final value is 0 only. So nothing again will come to the balance sheet. Now you can incorporate here. So 1000 rupees. 400 cancelled. 600, 200 already cancelled. So only 600 rupees. 400 rupees remains uncancelled. 500 plus 200, 700 remains uncancelled. Okay. 2700. And 1500 plus 500 remains uncancelled. And 600 was already cancelled. So 400 plus 300, 700 remains uncancelled. Total value being 2700. Is that clear? So without following the steps also you can get the answer directly. But steps gives you grip where we have multiple adjustments. So in case of multiple adjustments, you just follow the steps. Without steps also you can work out if you are mastering this. Right? Come on. Make a note of it. We'll move on to the next one. Shall I move on to the next one? 4 steps. 4 steps. Step number 1, finding the holding status, holding and minority interest. Second one is segregating the resource and surplus into capital and revenue. Third and fourth steps is to calculate cost of control or as well as minority interest. Fifth step is preparation of the final accounts, means consolidated financial statement. That's all. We'll now move on to the next one. In this illustration, again I am going to follow the same way. Okay. Now, holding status. Holding company holds 100%, 40 shares. Overall shares are there in S Limited also 100, so minority interest being nil. Second step, resource and surplus. 200 rupees in total. This total is segregated into capital profit as well as revenue profit. As nothing stated, we assume that the entire 200 exists at the time of acquisition itself, and no balance is there for the revenue profit. Okay, this 200 will be shared to holding as well as minority interest. Similarly, this 0 also be transferable to shared to minority interest as well as holding company. 100% held by holding company, so the entire 200 goes for holding company. Minority interest being 0, here also 0. This you no need to worry about that. This is also has no meaning at all. So we have to record only this one. Step number 3, you have to find out the cost of control. By solving this, you will get the goodwill or capital reserve. Fourth step is minority interest. Now, cost of acquisition of the shares in the company being 700 rupees. Now I take this one. Already I have taken this 200 rupees. Now I am taking this 700 rupees. This 700 rupees I paid for the net worth of this company. The net worth of this company being equity share capital 400 rupees. Out of 400 rupees, holding company status being 100%, right? So 100% is for him only. For the minority, the equity share capital being 0. As well as this capital profit of holding company is now transferred from here to here. Capital profit 200 rupees. And other profit, this one, profit will be transferable here also 0. So nothing will be there. And this is addable with this. It also has 0 value. Now the net worth being 600 rupees. 700 is the payment value of done for the worth of 600 rupees. Excess payment is there by 100 rupees. This is called goodwill. Goodwill will be part of. Now from this I have to incorporate that in the balance sheet. So this 100 will go here as intangible assets, a part of non-current assets. Goodwill, right? So nothing left untouched in adjustments or working notes. Hereafter you just do line by line additions of the leftover item here. So here 1000 rupees being the equity share capital, here 600 rupees, the 200 was already taken, so only 600, and here it's a 400 rupees, here 500 plus 200, both the value will be taken, nothing remains touched, and 1400 plus 500, 1900, and this being 0, and 400 plus 700, 300, 700. Overall value being 2700. Now you get the consolidated balance sheet here. Clear? If it is okay, text me. We will move on to the next one. Let's move on to the next one. Prepare consolidated financial statement from the following. Shares held by holding company being only 60%. Step number 1, holding status. His company has 60%, balance 40% held by outsiders named as minority interest. Minority interest. Step number 2, segregation of the resource. 200 rupees is there, resource and surplus. Total resource and surplus being 200 rupees. Segregate that into capital profit and revenue profit. As nothing stated with respect to the capital profit segregation, we assume that the entire 200 being capital profit only, revenue profit being 0. After that, capital profit will be shared for holding company as well as minority interest. Similarly, revenue profit should also be shared for holding company and minority interest. The capital profit being 200 rupees, out of that holding company share being 60%, 120, 40% is for the minority interest, which is 80 rupees. And in revenue profit, this is being 0 only, 0 only. It has no meaning at all. Okay, step number 3, minority interest. For the minority interest case, you know, clear. You will not have the segregation of capital profit and revenue profit. It's only profit. It's only profit, right? Third one, cost of control as well as minority interest. You have to prepare these two working out parallelly. The amount paid for acquiring the shares in the company being 300. So I am going to take this one, 300 rupees. Net worth of the company being, I am going to take the equity share capital. The equity share capital being 400, out of that, holding company status being how much? Only 60%. Only 60% is paid by holding company. So for the 60%, it's only 240. Rest will be for the minority interest, 160. Similarly, the capital profit of holding company will be addable here, 120. And minority interest profit share, we don't have capital profit, revenue profit classification here because we are not sure When did he purchase? It's all about our case. We purchased so and so date and need to find out what is the profit as in the date. That will be the capital profit. Any profit after that being revenue profit. But here, such a date of acquisition will not be a matter. Here, 80 plus 0, 80 only. And this is also 0. This is also 0. So I have recorded this one and recorded this one, recorded this one. No more required to post that anyway. Once it is getting ticked, no need to worry about that item to be recorded further. So the net worth of 60% share being 360, but the payment is only 300 rupees. So you paid 60 rupees lesser. As you are paying lesser, then it is called capital reserve. And shares held by outsider being 240. These two are going to be recorded. So capital reserve will be part of your reserves and surplus. Your reserves and surplus being 600 rupees and 60 rupees being capital reserve and minority interest being 240. Leaving that rest, this 100 rupees will be posted as it is, 600 posted, this 400 rupees is going to be posted here, debentures, and 500 plus 200, 700 rupees, and 1800 plus 1500, 2300, and this one is dash 400 plus 300, 700. Overall total being 3000 rupees in assets as well as in liabilities also. Hope it is tallying, right? Come on, text me. Yeah. Text me once it is over. Online students, come on. Sivaram, Satyamurthy, Kamakshi, Pandya. What about the others? Make it faster. Now, let's move on to the next one. Question number 4. H Limited company acquired 24 shares in S Limited when S Limited had 100 in resource and surplus. The overall resource and surplus being 200, but at the time of acquisition, the resource and surplus being only 100. So remaining 100 will be post acquisition. Now I have included the post acquisition profit also, a comprehensive illustration. We'll start with the first one. Holding status. Holding status. For holding company, they acquired how many shares? 24 shares. How many shares are there? 400 rupees, 10 each means 40 shares. So 24 shares held out of 40, then 60%. Then remaining share 1 minus 60%, 40% held by the outsider called as minority interest. Step number 2. Reserves and surplus. Total reserves and surplus being 200 rupees. Now I am going to take this one. I am going to segregate the two, capital profit as well as revenue profit. As on the date of acquisition, the capital profit, the profit exists being 100 is called capital profit. Any profit earned after that will be named as revenue profit. We assume out of the total 100 capital profit means balance being revenue profit. This 100 will be shared to a holding company as well as for minority interest. Similarly, this 100 is also a share goes to minority interest as well as balance will be for holding company. Here the holding company's share being 60% out of 100, 60 rupees is for holding company, 40 for minority interest. Similarly, in revenue profit, 40 for minority interest, 60% for holding company. Okay, set number 1, set number 2, set number 3. You have to incorporate all these things. And step number 3 and 4. One is all about cost of control. Another one is all about calculation of minority interest. Cost of acquisition of the share in the subsidiary company by a holding company. The 24 shares purchased for how much? For 400 rupees. Once I have taken, then it will be cancelled. This 400 rupees is paid for the net worth of S Companies Limited. Equity share capital of S Company being 400 rupees. All the 400 not purchased, only 60%, 240 is purchased. So 240. Balance 160 will go to the minority interest. So here equity share capital being 160. 160. Clear? And this capital profit will be forming part of the net worth here. So I add that also here, which is 60. And minority interest share, okay, profit will be around 40 plus 40, 80. And holding company's profit, revenue profit will be addable with the revenue account. So here you have to add this. Clear? Now, the net worth of the 60% share being 300, but the payment is 400 rupees. You paid 100 rupees excess. That 100 rupees is called goodwill as you pay excess. And the portion held by outsider is 240, including the profit also. This is called minority interest. Now I am going to incorporate all these things. Equity share capital being 1000. Resource and surplus being 600 plus 80, 680. And minority interest being, I have to introduce the new one, 240. And we have completed all these values. This 400 rupees being the debenture. 500 plus 200, 700 is the current liabilities after the consolidation. And non-current assets, intangible assets, goodwill being this one. Goodwill being 100 rupees. And tangible assets being 2200. We don't have investment value, and current assets being 700. What's the total value? 3000. Come on, tell me whether it is agreeing or not. Which one? This one, nah? Okay, 660. Okay, 60. Okay. Now it's agreed. So check, is there any unticked item in the adjustment? Also got ticked, 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 means requires no adjustment. Once all these things are perfect, then definitely balance sheet will get tallied. Come on, make a note of it. Question number 5. It includes revaluation of assets also. That revaluation of assets has no impact on depreciation, right? As usual, you will start with first one, holding status. How many shares are there? At the rate of rupees 10 means 40 shares are there. Out of that, H holding being H Limited company acquired 32 shares in S Limited. When S Limited had 300 in resource and surplus. Okay. Now 32 acquired out of 40, then 80%. Am I right? Balance 20% held by minority interest. Step 2, segregation of resource and surplus. Resource and surplus being 200. I am going to take this now, total. I am going to share that to capital profit or pre-acquisition profit and post-acquisition profit. I am using the different name. Post-acquisition profit. Out of the 200 rupees, how much exists at the time of acquisition? 300 rupees. What about the post-acquisition profit? Come on. 100 loss. On acquiring, we came to know we have around 300 rupees worth. Immediately after the acquisition, in a matter of remaining 1 or 2 years, we lost around 100 rupees. Any of the pre-acquisition profit remains the same, should be shared to the holding company as well as minority interest. 80% for holding company. Out of 380%, 240 for holding company, 20% 60 for minority interest. Similarly, out of 100, 20% for minority interest, 80% for holding company. This will be capital profit, will be part of net worth. This will be minority interest worth 40 rupees. This will be adjusted in the revenue profit itself. Right. And the non-current assets of estimated companies valued at rupees 600 on the date of acquisition. The non-current assets, tangible assets 500 rupees. But we came to know the value of this being 600 rupees. Is that okay? Then what happens? We introduce one new adjustment here. Third, revaluation of assets and liabilities. Book value being 500, revalued value being 600. 100 rupees is the revaluation profit. This revaluation profit, will be always called as capital profit. Okay, based on the real value of the assets as on the date of acquisition, I will decide. See in the balance sheet, land and building 1000, plant and machinery 500. Okay, so equity share capital being 1500. No other asset exists. How much will you pay for purchasing this? So you are pretty sure that two assets are there, 1500. One asset 1000, another asset 500, 1500. But only thing this land and building purchased in 1960. Land purchased in 1960 may be dead cheaper. Plant and machinery may be obsolete. But land and building purchased for 1000 rupees after 40-50 years, the value may be many-fold, probably 1 lakh. So now I am willing to pay 1 lakh rupees, not 1500 rupees, based on the real worth of the company. So whatever the purchase consideration I do, 600 rupees, is keeping that revalued worth of the assets also in my mind. So while calculating cost of control, the revaluation value will also be incorporated here. So this will be considered as what? Capital profit. Okay, this will be considered as capital profit. This 100 rupees will be adjusted twice. One is add with the asset account. Asset account will be inflated by 100 rupees while preparing new one, consolidated financial statement. Second one is should be shared between holding company and minority interest. This benefit is not only for the holding company, it's for minority interest also. The holding company share is 80%, so 80% will be taken to cost of control calculation. Another 20% will be addable with the minority interest. Clear? That's all. That's how you can incorporate here in case of revaluation of assets and liabilities. Yeah, okay. Now come on. The next step is to calculate cost of control and minority interest. What about the cost of acquisition? Cost of acquisition being 600 minus net worth. Net worth is nothing but equity share capital. 400 rupees is the equity share capital. Out of that, holding company holds 80%, 360. Balance held by the minority interest, 40. Capital profit will be addable with the net worth, capital profit or pre-acquisition profit, the value being 240. Minority share, okay, profit, 60 minus 20, 40. And holding company shares minus 80, minus 80. and asset value should be appreciated by 100. This 500 becomes 600 rupees, and holding company's value 80 will be addable here. So revaluation profit, RP, revaluation profit 80, revaluation profit meant for the minority interest being 20. See, this one got ticked, 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 this one also ticked, and this one also ticked. Now the overall net worth of the assets being, come on, 680, I think, right? But the payment is only 680 rupees. You pay lesser, then it is called capital reserve. And held by outsider being 100 rupees. Held by outsider being 100 rupees. Okay. Equity share capital wrong, I think so. 80% being, okay, this being 320, 20% being 80 here. Then this is 140. This being, yeah, 320, 400, 640. Actually, you are paying lesser by 40 capital reserve. Everything got ticked, only these two are going to be ticked. Equity share capital being 1000, reserves and surplus 600 minus 80, 520. Apart from that, we introduced capital reserve 40, minority interest 140, debentures remains the same value, current liabilities 500 plus 200, 700, this value being 1500 plus 600, 2100, investment becomes 0, 400 plus 300, 700, overall value being 2800. Minority interest should be before non-current liabilities and after the shareholders funds. Okay, clear? Come on, make a note of it. See, here we have been given revaluation of assets, and we are supposed to provide the depreciation on the revalued worth later. If the asset being 1 lakh, depreciated at the rate of 10% means 10,000 rupees. If you are appreciating the value from 1 lakh to 1 lakh 50, thereafter the depreciation being 15,000 rupees. Am I right? You understand? Remember, in case of revaluation assets, along with the depreciation, revaluation of assets, if there is any revaluation profit, this revaluation profit will be capital profit. This is called capital profit, capital profit nature. Right. But subsequently, there will be revenue loss. There will be revenue loss. Depreciation on that will be the revenue loss. Is that okay? Plant and machinery are, okay, plant and machinery being 1 lakh. Applicable depreciation on this being 10,000 rupees. Suppose if you are revaluing the plant and machinery to 1,50,000 rupees, 1,50,000 rupees, what happens here? There's appreciation of rupees 50,000. Am I right? This appreciation is capital profit. Okay, as on the date of acquisition, whatever the change in the value of the assets will be called profit, right? Capital profit. Yeah. So capital profit, that 1 lakh becomes 1,50,000 now, it is called capital profit. But if the value being 1 lakh, depreciation being only 10% on this. As you are appreciating the value from 1 lakh to 1 lakh 50, hereafter the depreciation being 15,000. When? After the revaluation. Revaluation is the date in which you are acquiring. After acquisition, because of the revaluation, the depreciation amount will be increasing. Any profit or loss after the revaluation period or after the acquisition will be called as revenue profit. So this excess depreciation will be done only after the acquisition period. So this will be called as revenue item. Now the question is a profit or loss? Excess depreciation is a loss. So revenue loss. So when there is a revaluation profit, there will be capital profit. Corresponding, there will be revenue loss. Depreciation on the capital profit will be the revenue loss. Suppose in revaluation, if there is a capital loss, definitely later on you will have revenue profit. Revenue profit. You understand now? So this is most important case when it is all about revaluation of assets along with the depreciation. So most of the students will get confused only this part. Right. This concept I have explained is pretty simple. Anything having revaluation, due to that, if there is any profit or loss, that's a capital profit or loss only. But this will have the impact in the future dates in depreciation. Depreciation will be after the acquisition date, so it is always revenue profit or loss. If the value of the asset appreciating, happy capital profit is there. But because of the acquisition, there is an unhappy. In the future, depreciation will be higher. That leads to revenue loss. So capital profit in association with the revenue loss and capital loss in association with the revenue profit will be there. That's first thing you have to understand. Second important point is, as I have given here, beginning value and revaluation worth. Such a way it may not be directly given. In your examination, the acquisition date being, say, half of the year, but the revaluation done in the year beginning. Then how can you adjust that? Let's see, to make you understand, let me try to solve this question number 6 so that you will be able to understand everything pakka. Okay. Prepare consolidated financial statement from the following balance sheet. Everything is okay. The shareholding being 80%. So step number 1, percentage of holding 80% and 20%. Date of acquisition of share in S Limited by H Limited 1/10/2021. So 1/10/2021. So exactly half year. This is 31st March 22. So financial year ends on 31st March and acquisition happens on 1/10/2021 means exactly half year. When S Limited had 100 rupees in reserves and surplus. So the reserves and surplus. Pre-acquisition being 100. Okay. Non-current assets of S Limited being 600 on 1/4/21 was revalued at rupees 670 on the date of acquisition. Clear? This is very, very important. What about the non-current assets value? Tangible assets 540. 540. Non-current asset value being 540. When? 31st March 2022. Clear? Non-current assets of S Limited being 600 on 1/4/21. Okay. WDV on 1/4/2021. Okay. What about the book value? What about the book value? 600. 600. From that, you have to subtract the depreciation for the year 21-22. Then the WDV value as on 31/3/2022 being 540. So from this, it's very clear. Depreciation over the period is 10%, 60 rupees. Our depreciation percentage being 60 by 600, 10% is the depreciation rate. So year end we have the value being 540. Year beginning the value of the asset being 600. Over 1 year's period it got lost. its value by 60, which is nothing but depreciation. So 600 becomes 540. Out of 660, 10% being the depreciation. Is that clear? Was revalued at 670 on the date of reacquisition. This 670 is the revaluation when it happened, as in the date of acquisition. When it is acquired, 110.21. Now we need to find out what is the value of this particular non-current asset as in the date of acquisition. We have been given the value of the asset as on 1/4/2021, as on 31st March 2022, not as on the date of acquisition. Now we can calculate the value of the asset as on the date of acquisition based on the rate of depreciation. See here, WDV on 1/4/21 being 600, and you have to find out the depreciation up to 110.21. How many months are there? 6 months. So 10% is the rate of depreciation per year for 6 months, 30 rupees. So 570 will be the WDV as on 110.21. Is that okay? This is book value. Revalued worth being 670 as on the date. It means 570 is the value of the asset as on the date of acquisition. But on verification, we came to know the real value is 670. It got appreciated by 100 rupees, capital profit. This is capital profit. For the remaining period, depreciation up to 31st March 22. March 22, depreciation. So for the second half, 10% will be the depreciation per annum. Here 30 rupees. 30 rupees. Per year 60 means first half year 30, second half year is 30. But it is for the original book value. As for the revised value, the value increases by 100. For the 100, again calculate 10% at the rate of 10% for 6 months. Because from this date to this date, we have only 6 months. For the 6 months, at the rate of 10% for 6 months being only 5 rupees. So your depreciation increases from 30 to 35 for the second half. Okay, second half. Now WDV, revised WDV as on 31st March 22 being book value 540, but revised value being 635, net impact in the value of asset being 95. So 100 rupees appreciation as on the date of acquisition being the capital profit. Thereafter, there is an appreciation in the case of depreciation. So this is being the loss, and that loss is called revenue loss. So revenue loss. Ultimate value will be adjusted in the asset being this one. Adjustment will be done in asset value. Is that okay? Clear? This calculation is pretty important for this one. I want at least this part. Is that clear? I'll keep it here. Rest of the things are pretty simple. Rest of the things are very simple. Okay, you can calculate the rest of the things as usual. Now, what about the resource and surplus? Resource and surplus total being 200. Out of that, pre-acquisition profit as well as post-acquisition profit. How much is that? 100 rupees. So 100 rupees being the pre and another 100 rupees being post, and I shared this for holding and minority interest. %80 for holding and 20 for minority, and post acquisition also 20 for minority, 80 for holding company. Okay. So next one being cost of control and minority interest. Cost of acquisition being how much? 600 rupees. We have taken this 200 also. 600 rupees. Is that okay? Minus net worth. Net worth includes equity share capital face value. 400 rupees. Out of that, holding company's share being 80%. 320, and minority interest share being 20% is 80 rupees, and capital profit being 80 included here, total profit included here 40, and this capital profit will also be shared to holding and minority. Revaluation profit, how much? 100 out of that 80% is 80 rupees will be part of net worth. Revaluation profit for the minority interest being 20, and this one revenue loss 80% for minority interest 4 rupees, another 1 rupee will be adjustable here, minority interest. It's a revenue loss, right? 1 rupee being loss. This is what about the depreciation, increase in depreciation, post acquisition profit, and ultimate revenue profit transferable here being 600 plus 76 plus 76, 80 minus 4, 76, and the value asset will have impact being to the extent of 95. So 540 will be included, will be increased by 95, 635. Sir, 100 rupees, sir. Yeah, 100 rupees is the revaluation profit. After that, 6 months happen, no, for that increased depreciation 5 rupees should be deducted. So net impact in the asset being only 95, capital profit minus revenue loss. In case of capital loss, revenue profit will be there. So net will be adjusted in the assets account. Now what about the overall value here? 480, but you paid 600 rupees, as you pay 120 rupees excess. This is called excess payment, is called goodwill. So intangible assets, goodwill being 120. And what about the minority interest? 139, am I right? So here equity share capital 1000, reserves and surplus 600 plus 79, 76, 676, and then goodwill is here, minority interest 139, non-current liabilities 400, and current liabilities being 700, and tangible assets 1500 plus 635, 2135, and current assets being 660. Yeah, get me the total here, 2915 and 2915. Is it agreeing or not? Yeah. So main point is this one. In this illustration, you have to consider this part. Once it is over, then revaluation related concept is completely over. Next one is all about mutual owings. You have to solve as usual, but finally while merging, you have to cancel the mutual owing. Debtors and creditors BRBP will be cancelled. That's all. Okay. Come on, make a note of it. So rest will continue in the next class.